For anyone who's suffering from a bit of regulatory fatigue, you'll be pleased to know there are very, very few technical details in my talk. My talk's all about communication, which, coming from an actuary, you might find a tad ironic. I'm normally, traditionally, very good with numbers and not very good with people, so good luck. I work with small insurance startups who are trying to break into the conventional insurance market, and with conventional insurers who are trying to find innovation that works for them. And both sides of that debate are desperately searching for the other, and very few seem to be connecting. And I find that fairly amusing. What's the relevance of regulation? Well, I think it's one of the key drivers for why that debate isn't successfully reaching its conclusion, and that's what my talk's about today. In the interest of my minus 1 minute time, 9 minutes, 20 seconds, I will be speeding through some slides, so I reserve the right to give very few bits of detail. Insurance regulation is kind of a big deal. So my agenda is going to be split into 3 topics. The relevancy of regulators to this debate that I'm talking about in the first place. Excellent, perfect. So first of all, why are regulators relevant? Why is regulatory regime such a driver of that connection, and why is it so important? Once we identify that, what can we do as insurtech, insurers, intermediaries, or perhaps analogies from other industries? What can we do to make that happen successfully? And then finally, just some closing thoughts about, before you rush away and sort of brush up on your regulation, what you might want to think about in advance. So firstly, from an insurance perspective, who are the main regulators? And I'm going to stick to the UK for the bulk of my talk. All of this would be relevant elsewhere. The main ones you'll be talking about are the FCA. We've heard from Helen, who's run away from my talk, and we've got the PRA as well. Now, shortly speaking, insurance intermediaries will know a lot about the FCA, but less about the PRA. Insurers who are prudentially regulated by both, dual regulated, will be very, very concerned with the PRA. And as an actuary who's very quantitative, I'll be focusing some of my debate on the PRA in particular. There are lots of other regulators. I've brought one example up here as well. All of this could apply, so bear that in mind as we move. Now, which regulators do we care about as an insurer? Well, let's do the easy and slightly boring case first. I want to be an insurance company. That's my goal. I want to come up with an innovative product. I want to write it myself. I want to own the entire process. Well, in that case, I'm dual regulated. The PRA ultimately providing my licensing approval. Why don't we see many people going down that route? Well, that's a lot of work. There's a lot of effort involved in getting PRA authorization, some fairly significant capital requirements, with exceptions, which I can talk about later on if people want, but it puts a lot of people off going down that route. So what about the people who don't want to be insurance companies? So I want to be an insurance intermediary. So examples, I want to come up with an innovative way of engaging with customers, or with distributing insurance products to the market, with managing or analyzing data and helping insurers that way, or perhaps at the end of the chain, handling claims. What do I need to be thinking about? Well, I hinted earlier that I need to be regulated by the FCA. They'll be supervising me. But again, my answer here is going to be both. And actually, I think that single word there is a key driver for why those discussions are breaking down at the moment. Why is it that we need to be thinking about both? Well, from my perspective, it's quite simple. If I choose a few examples of those intermediaries, so innovators in sales and distribution, the data side of things, in claims handling, those are intermediaries who are regulated by the FCA, and they know their stuff. And what they need really badly is to find customers who will buy into their innovation, who will work with them to make that a reality. Unfortunately, the reality is that those customers are often insurance companies who are themselves regulated by the PRA. Now, we're going to move on to a specific aspect of that regulation now, but the takeaway is that if you are dealing with any customer in any industry, you need not only be aware of your own regulation, but theirs as well, because it will certainly cast a significant light on any of your dealings with them. So what does all of this mean for us now that we know both the FCA and the PRA are relevant for all of our insurance intermediaries? Well, it's all about tailoring our message. I'm going to get on to Solvency II, which is well known. There's at least some people sniggering in the room. It's the most significant regulatory regime change in the UK. It's PRA over the last, I believe, 8 years now. It's been sort of slowly coming into motion. I'm going to start off with some quotes from the FT in 2013 about insurance intermediaries under this regulatory regime. To be at the table, intermediaries will need to demonstrate strength in a number of key areas: financial robustness, risk management processes, business model and its sustainability, client base and relationships. They should look at their own business through the eyes of providers who will be influenced by their risk management requirements. Advisors should ask themselves what, if any, aspects of their own business and the way that they conduct things would provide chief risk officers cause for concern. So all of those items add up a little bit to, you should imagine you're regulated by the PRA yourself. So what is Solvency II? What is the thing driving this? And here's where I'm going to get a little bit actuarial, so apologies for this. Very briefly, and it's going to be in less than 4 minutes, a high-level intro to Solvency II. There are some quantitative requirements: how you're valuing your assets, how you're valuing your liabilities, how much capital do you need to hold. There are some qualitative requirements. How are you managing risk, not just now, but moving into the future? And there are a lot of disclosure requirements as well. What are you reporting? How much information do you have available in what form to be passed through to the regulator? And all of this covers lots of the usual suspects with regards to risk: insurance risk, credit risks, operational risks, market risks, the list go on. Now, years of being burdened with complying with this, from an insurer's perspective, has led to a mindset where all of this is the first thing that pops into mind when a new proposition arrives. So from an underwriter's perspective, if an intermediary arrives with a new form of innovation, they will be thinking quantitatively: what does this mean for the book that I'm writing? What will this mean for the insurance business that I'm involved in? Qualitatively, given that my requirements extend not just to me, but the people I'm working with, how are people handling their data? What are they doing about their credit risks? How are they keeping all of their risks under control? And they'll be thinking from a reporting perspective: what can I get from that person that I need? How can I make sure that I have everything available to me that I need to be compliant with Solvency II? So, from an insurtech perspective, no matter where you are in the chain, insurance company, distribution channel, customer engagement, you should be thinking quantitatively. What does my business model mean for risk profile? What does it mean not just for the mean result? How do things vary? Where are the big risks and where are the big numbers going to come from that are going to scare an underwriter away because of the capital required to support the business? Qualitatively, how am I demonstrating that I'm managing risk effectively within my business? Not just within sort of SCA compliance perspectives, but also from a Solvency II perspective. Do I understand the compliance well enough? And then I should also bear in mind the costs of ongoing compliance. It's not just today. It's not just convincing someone that they should lead with me and that I can give them good business that doesn't introduce too much risk. It's that I, from an operational perspective, can keep complying and help them do that over time. So I'll have the right data available at the right point in time. I will always give the right information when they need it. Now I've sped through. I've got 1.5 minutes left, so do catch up with me afterwards, because that was meant to be more polished. Before we open the handbook and before you run away and find out everything you can about Solvency II, which I'm sure most of you will, there are some things to bear in mind here. And again, why haven't people cracked this negotiation problem? It's because of the next couple of slides. At a high level, regulation seems like a really sensible and a really easy to understand concept. 3 objectives: protect the consumers, protect the financial market in which you're operating, and promote healthy competition. In practice, that amounts to a lot of rules that are very hard to understand. Anecdotally, I've heard from more than one source now that the last chairman of the FSA had a printed copy of the FSA handbook, which was taller than him when you stacked all the pieces together. And he was taller than I am. So that was a big book. And also, that first quote that I skipped over on the insurance regulation is a big deal slide said that Solvency II has cost UK insurers £3 billion. The 2 points I'm getting at there is it's hard to understand and it's expensive to comply with. So there are natural barriers to people getting their heads around this stuff and complying successfully. However, it's not all doom and gloom. And I said at the very start, this is about communication, and communication is a two-way thing. That £3 billion amounts to a lot of people in the industry who've been on a similar route. So insurance peers who are out there, regulators who have helped others be on that journey, can help people trying to enter the insurance industry. And you met Helen. Can I have one more minute? Okay, I've passed the test. You met Helen earlier. Regulators are fairly friendly. We have a reputation globally at the moment for being very well-meaning towards innovators. We mentioned the FCA regulator sandbox earlier. We've also got pragmatic rules in place. So, for example, there are de minimis requirements around Solvency II, where if you're small enough, the regulation doesn't quite apply. Some of those authorizations I was explaining earlier are pragmatic, and they bend to accommodate people who are nearly there. And perhaps most importantly, there are lots of people who are happy to talk about regulation. You'd be surprised by the number of people who can go on and on and on about it. So from a takeaway perspective, I guess what I'm saying first of all is that regulation is really important because it influences the way people think. Over time, it gets built into the way they think, the way they assess businesses and what they get involved in. So Solvency II, in particular insurance, it's a particularly heavily regulated market over the last few years, and that needs to be a really important part of the way you communicate. So how do you convince people to go with you and support your innovation and make it happen? Well, speak the regulator's language, or at least speak the underwriter's language, or whoever your customer is and whatever their regulatory environment is. And then before you get there, you reduce the friction. You ask yourself in your own business proposition the tough questions before they do. So I know what the big risks are in my business. I've looked at them, I've taken a long, hard look at them, I understand what they are, and I know how I'm going to mitigate them. You don't need to worry about that anymore, so don't worry about the regulatory side of things. And then finally, it's really tough stuff, but there are lots of people who've been on this journey as well. You've got all of the peers who've spent the £3 billion adhering to the regulation, and then you've got the friendly regulators who've put it in place. So both sides of those will be really happy to talk to you and tell you how to help communicate what your innovation means for the insurance industry. And that's me. It's time to get talking. So speak to me first, I guess.
Any questions for Paul?
Yeah, I may have missed something that you went through in the talk, but is there a possibility of getting a similar regulatory structure to the one that we heard about for the FCA sandbox in insurance? Do you think that that's on the cards?
I have seen no sign of it whatsoever. One thing I will say is that I've been working with a number of people in the last few weeks, have really hoping that there will be. Particularly people who want to be insurers themselves and are looking at the capital requirements associated with that. I think for companies that are intending to be big enough for Solvency II to apply, for example, the ruling is that you need to be holding your 3-year capital from the day license is granted. So the reason for a sandbox, the driver for a sandbox from the startup's perspective is pretty strong. They're really after it, but I've heard no word of it myself.
I think just as a comment on the sandbox process, it would be interesting to see if the fintech tail ends up wagging the sandbox dog rather than the other way around. My suspicion is that it's going to end up being rather kind of taken over by the firms and people within it, which I think is a good thing, but I think it will happen.
Yep.
Okay, Paul, thank you very much. Thank you.